Now, this is a bottle of juice. In fact, it's mixed apple and orange. You can actually buy it from the shop for around about €2.89. But what is the real value of this item? What's the true intrinsic value of this item? And how do I know what the future real value of this product may be in the future? Let's talk about that. Hello there, this is James, and you're watching the latest episode of Trading Bytes. This is like a new little educational series I'm trying to put together. The reason why it's called Trading Bytes, because it's like little bite-sized pieces of information. So sort of whet your appetite, so to speak. Obviously down the line, we'll do a lot bigger courses, webinars and things like that, which will go into a lot more detail. But today, like I say, it's just a little bite-sized piece. Today's topic is Introduction to Fundamental Analysis, Part 1. And today I'm going to focus on currencies. Next episode I'll do stocks and then I'll do commodities. But today I want to quickly look at currencies. So what is fundamental analysis? Well, fundamental analysis is a study to try and find the real and fair value of an asset. The intrinsic value, not the speculative price, but the actual fair value of that asset. Okay? The theory being is that if an asset is undervalued, okay, then that could potentially mean in the future that's a buying opportunity. If an asset is overvalued, now that could potentially present a selling opportunity. So like I said, today I want to look at currency. So here's the big question I always like to ask. What makes one currency stronger or more valuable than another currency? I mean, they're both made of the same bit of paper, aren't they? But what makes one currency more expensive than the other? And the reason for that is the strength of a country's economy means that country's currency potentially should be stronger as well. So how do you measure a country's economy? And how do you measure if a country's economy is growing or declining, which could also mean in the future that currency could increase but also decrease? Now there's a number of key economic indicators you can study and you can watch, which comes out every month, which will indicate to you or potentially show you the strength of that country's economy. Let's have a quick look at just a few. For job market, traders look for things such as unemployment rate and job growth, like the non-farm payroll, which is massive in the United States. They're looking to see if the job market is a strain on an economy or a boost for the economy. Retail sales. Now, the modern day economy is based upon us spending our money. Are we putting money into the system? Which makes sense because A, that pays for the retailers, pays for the people who manufacture the goods and those who sell the material for those goods. Overall strength of an economy. This is measured by GDP, otherwise known as Gross Domestic Product. Now, is the GDP growing or is the GDP declining? And what will this GDP number be in the future? CPI, Consumer Price Index. Now this measures the overall price of a basket of goods. Inflation, in other words. Is it getting more expensive for us to buy the goods we need, or is it getting cheaper? And this leads to interest rate decisions. What is the central bank going to do? Is it going to increase interest rates or decrease interest rates? So there we have it, some very important and key economic indicators. But let's sort of break it down a little bit. Let's go into a bit more detail why these indicators matter and how traders can adjust and read these to try and look at the intrinsic value of a currency, how the economy is getting stronger and how it can affect potentially that currency or weaker, etc. So let's go with, let's start off with unemployment or job data, the job market. Obviously, if unemployment is rising, that means there's less people out there in the workforce, which also indicates a slowdown in growth in industry at the same time. As well as that, unemployed people then also becomes a strain on the economy because they need obviously financial support from the government, from the welfare state, things of that nature. On the flip side of that, if you see job growth, more and more jobs being created, like the non-farm payroll, which is a massive economic indicator, especially when you're trading the US dollar, and we will do a video on that at some point. You're seeing job growth, and that means industry and the economy is growing. That means there's more people being needed for employment, which also means there's more people who has money, spare money to potentially spend, and less of a strain on a country's resources, as in the welfare state or support from the government. So it's growth. So again, it's a positive thing, which could lead to obviously a strong economy, strong currency. It then leads us to the next thing, retail sales. Now, like I said, just a moment ago, the modern day economy is based upon us spending our money. They need us to go out and buy things. Buy the latest iPhone, buy the latest Samsung, buy the latest PlayStation. It sounds very directional what I'm saying, but you know what I mean. The latest, I don't know. Whatever, the latest goods, the latest things which are in demand, we're spending our money, we're putting our money out there. If retail sales are growing, that means there's confidence of the consumer. That means the consumer is not saving its money, it's willing to spend its money. That sort of thing, we're more comfortable with the state of the world around us. So we're spending our money, which again puts money back into the system. That money then pays retailer, pays the manufacturer, pays the person who's selling the material goods. So it's a good thing of putting money back into the system. So if we see growth in retail sales, again, that is positive potentially for the economy, which means potentially is positive for that currency. Then we go on to the big one of the big ones, which is the overall health of a country, which is the gross domestic product, GDP. Now, obviously, at the moment, the strongest GDP in the world is the United States. It's the world's number one economy currently. I'm not saying it's going to always be number one. Things change. I don't think it's going to be number one forever. I think there's a contender ready to jump in and take its seat. But again, if the GDP is healthy, which takes in a number of calculations, number of statistics to show how strong that economy is. If the GDP is growing, seeing growth, then again, that's very positive for that country's economy. Again, potentially very positive for that country's currency as well. Then we lead on to CPI, Consumer Price Index. Now this, over the last 2 years, has been a major thing. Because don't forget, the world, since obviously 2022, or the beginning of 2022, has faced a massive inflation issue. And this is what CPI, Consumer Price Index, because don't forget, it measures the price of a basket of goods. If it's increasing or not, things are getting more expensive for us to buy. Now, this is a major thing. The reason why it's so major is, for one, if it's getting more expensive for us to buy products we need, like milk, like bread, orange juice, like we did at the beginning of this video, then we'll probably have less money to spend on other things. We may also at the same time be a bit more concerned about getting rid of our cash. our savings to put back into the system. So we're likely to save a little bit more or cut back on certain luxuries. So CPI is a major, major thing, because if it's more expensive, we'll slightly need to spend our money. We'll be a bit more careful, which again stops the money going to the system, which means the whole system then starts to slow down. Which leads me to the final thing I want to talk about. And this is the one thing which is linked with CPI or consumer price index quite heavily, and that is interest rates. Interest rates. What the central bank of that country decides to do with interest rates, because one of the main things they can do to bring down inflation when CPI is high is they raise interest rates. Why? To try and bring the cost of products down. Stop us from spending our money. Now here's the thing. When the economic situation of the country is good, okay? Well, actually, let's do it the other way around. If an economic situation of the country is bad, and where things are not growing so much, what the central bank does, or what central banks tend to do, is they lower interest rates. This is called loosening. The reason why they do this is that, for one, lower interest rates means our money in the bank is making no savings because the interest rates are very low, so it makes very little sense to make any savings on that. As well as that, it's cheaper to borrow money. So it's cheaper for us to go out and get loans, to go and buy things. The same as it's cheaper for corporations to take out financial loans to buy stuff. It's cheaper for us to get mortgages. The idea of loosening and lowering interest rates is that it will give us the encouragement to borrow, to develop, so we can develop certain things. So, for example, business will borrow so they can build their business up, or we can borrow so we can still put money back into the system or buy houses and things like that. The idea that it will like kickstart the economy, that basically means we all get back in and spending our money again because it's so cheap to borrow. Let's go and buy that latest car. It's so cheap the loan. Let's go into that business. Okay, let's expand and get that latest piece of machinery or whatever. When things are good, when the economy is stable, when employment is good, when the job market is good, or when retail sales is stable and inflation is high, the central bank does something different. They would do what's known as tightening. And this is when they increase interest rates. The reason why they do that is they try and do that to try and encourage us to start to save. They try and encourage us not to borrow so much, to slow it down, because the economy is stable and it brings down inflation. That's called tightening. Now, how interest rates affects currencies is because if a country lowers interest rates, or a central bank, lowers interest rates, it means that country's economy is struggling. It means that they are having to inject it with a boost. So whoa, okay, that's not good. That's not a good sign. That economy, that's not a good sign for that currency. If they raise interest rates or tighten interest rates, that means that is a good sign. That means that economy is pretty strong. So that's a good sign that that currency and that economy is pretty stable for them to be able to be in the position to raise interest rates because they believe the economy can take it. If that's the case, then they think that currency is reasonably stable and reasonably strong, so it shows growth. So all these little things, a couple of little indicators we've gone over there, and there's so much more than just these. There is loads more, but these are the major ones which you can follow. All give you the impression of how strong that economy is and how strong that potential currency could be. And don't forget, when we look at fundamental analysis, we are really looking in the medium to long term, how strong that currency could be in the future. Like I said, this is just trading bites. This is just a small little bite-sized piece of it. We'll be doing full webinars and full courses later down the line. And like I said, this is only part one. I'll be doing part two, soon, where I'll be talking about stocks. And then part three, when I'll be talking about fundamentals, about commodities. And guess what? Yes, we'll be talking about gold in that topic, because those who know me know I love gold and I am a gold trader. Anywho, I hope you found this little video interesting and insightful. But anyway, don't forget, until next time, these little videos are for educational purposes only, and in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research, do your own due diligence, and of course, know the risks at hand before entering any trade. Till next time, every single one of you, trade safe.